number 5, and you're actually going to buy that house. This is when I say to people, choose your first house very, very carefully, because this is a really, really important purchase. A lot of people go and spend as much as they possibly can on that first house just because the bank said they could have lots of money. So just because the bank says you can have $1 million doesn't mean you should borrow $1 million. This is where I urge people to have some caution and to be sensible with their purchases. And there's a reason that I say this. It's not because I want you to live in an average house. I want you to have a really nice house and a really nice life. But I also know that one of the really important key indicators of future wealth is having no mortgage on the house that you live in. And if you believe me on that one, which hopefully you do, this means you're going to make a sensible purchasing decision when you buy that first house, because maybe you're going to buy a 750 house and not a 950 house, or you're buying an 850 house and not a $1.2 million house. I urge people to forget about keeping up with the Joneses, because the thing about having all that value in the house that you live in is basically useless value. Like, it doesn't really put any more money in your pocket. It only does when you sell it one day. But really, you want to get yourself freehold and you want to get yourself gone of that mortgage as fast as possible, which is why I say to people, be sensible with your buying purchase so that your mortgage is reasonable and then you can get rid of it as fast as possible. One indicator is your mortgage repayments should only be about 25% of what your take-home income is. It's actually quite hard to do that in New Zealand. So I kind of allow that to stretch to, say, 30% or 35%. But if you're giving away 50 or 60% of your income on mortgage repayments, you're cutting out a real tough path for yourself. So that's number 5.